morning. February 1, 2022 school land board meeting will now come to order. Pursuant to section 31.015 of the Texas Natural Resources Code, I'm chairing this meeting in the commissioner's absence as chief clerk, as the commissioner is away on state business. Should the commissioner return prior to the conclusion of this meeting, I will relinquish the chair to him. The February 1, 2022 meeting of the school land board is being held in person at 1700 North Congress Avenue, Stephen F. Austin Building, and by video conference call as authorized under Texas Government Code section 551.125. Access to the meeting by members of the public was published in advance in the Texas Register in accordance with the Texas Open Meetings Act. Any member of the public who wishes to address the school land board should indicate so at the start of the meeting or during any public comment period. And I believe we have Bill Hyenga and Adam Green with McElroy, Sullivan, Miller, and Weber. They're available to answer any questions on item number 3. And before we get started, I did want to make the announcement that Todd Williams has officially resigned his position on the school land board effective January 10, 2022. We are awaiting word from the governor for replacement. So with that being said, first item on the agenda is item number 1, approval of the minutes from the January 4, 2022 school land board meeting. Once you've had a moment to review, I will take a motion to approve.
Go ahead, Michael.
So moved.
Second.
Motion is made, seconded, and carries unanimously to approve the minutes. Next item on the agenda is approval of the consent agenda.
Move to approve.
Second.
There is a motion made, seconded, and carried unanimously to approve the consent agenda. Next item on the agenda is item number 3.
Good morning, Robert Hatter with Energy Resources Division. Item number 3 is a request by Hillcorp Energy Development LP for a suspension of their oil and gas leases in East Bay, Galveston County. Hillcorp has 3 oil and gas leases in East Bay. These leases were awarded by the school land board in April of 2018. In November of 2018, Hillcorp applied for an application from the Corps of Engineers to drill a well on these tracts. Wetlands area, it requires a Corps permit. Hillcorp has finally received an approved permit. However, that permit required them to perform on-site mitigation and to place a deed restriction on the mitigation area to prohibit further future development of that area. To do that, they had to acquire the property. The property owner was under a U.S. court-appointed receiver, and it took 14 months for Hillcorp to finalize the purchase of the mitigation area. Section 52.0301 of the Natural Resources Code authorizes the school land board to grant suspensions of oil and gas leases when it is denied access to the property. On April 21st, 2020, the school land board granted a 12-month suspension of the lease that ended on April 3rd of 2021, and the school land board granted a second extension that ends on April 3rd, 2022. Hillcorp's hopeful to be able to get out there and start drilling that well, but because of the delays in acquiring the mitigation area, they're requesting an additional 6-month extension or suspension to April 3rd of 2022. Staff has reviewed it, and staff recommends that the board approve the 6-month suspension until October of this year. I'd be happy to any questions.
I move to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 3. And next item on the agenda is item number 4.
Again, Robert Hatter with Energy Resources Division. Staff is requesting approval from the board for the tracts, terms, and conditions for an April 2022 oil and gas lease sale. The staff requests the approval of 250 tracts for the lease sale, covering approximately 120,000 acres. Of the tracts, 69 of those tracts are upland tracts, with 23 of those being in the Delaware Basin, and then 127 of those tracts are in the Gulf of Mexico. 54 of them are in the Bay. So We haven't seen a lot of activity in state lands of late. So this is kind of a late development where with oil prices up, hopefully we'll see some more development in state waters at this point. Bonus per acre will range from $100 an acre to $750 an acre, depending on location and geology. The royalty rate will be, uplands will be a fixed quarter, 25% royalty. Offshore will use the same variable royalty rate that we have used on the past couple of dozen lease sales, which would be between a fifth and a quarter, depending on when they actually develop the tract and get first production. Primary term would be 3 years for upland tracts, and then for offshore tracts on submerged lands, primary term will be 5 years. Rentals will be $10 an acre for years 2 and 3 for upland tracts, and also for submerged tracts, and then $25 per acre for the year for submerged tracts. The key areas are Galveston Bay, the Gulf of Mexico, Laguna Madre, and some tracts up in the Panhandle near the Canadian River. I'm happy to answer any questions. Staff recommends approval. We also will need to set a date for it because we'll be doing this lease sale online or EnergyNet again, and I'll need to set a date. Currently, the first and third Tuesdays in April would be the 5th and the 19th. So if I can get any direction from the board on which date might be best. If not, I can set a date, and then we can just handle the opening of bids as necessary. Staff recommends approval.
So a couple questions, Robert. Thanks for all this.
Yeah.
Is there anything outside the ordinary on any of this? Is there any outlier?
No, sir. Like I say,
Okay.
we don't have that many upland tracks left. Most everything in Delaware Basin is leased. So, we've got some deep rights and some stuff we've gotten back. But it's all identical to the sales we've done in the past. The only thing that's different is that we have quite a few offshore nominations.
And I would just say it seems to work well when the auction is on the same day as a board meeting.
Yes, sir.
I move to approve.
Second.
Okay, there is a motion made, seconded and carried unanimously to approve item number 4. Thank you, Robert. Next item on the agenda is item number 5. This is a non-voting item. It's quarterly investment report for the period ending September 30, 2021.
Thank you, Mr. Chairman. Members, for the record, Rusty Martin, Chief Investment Officer of the General Land Office. Good to see you again in person. It's been a while. I'm pleased to present you with a quarterly investment report of the TexGlo Permanent School Fund Investment Portfolio for the period July 1st through September 30, 2021. As you're aware, the performance measurement calculations and statistical data that are presented in the report were prepared by State Street Bank and its private edge group, which are the custodial, accounting, and performance measurement agents for the portfolio. Starting with an executive summary of market conditions for that quarter, third quarter 2021, U.S. GDP increased at an annual rate of 2.3%. That was following an increase of 6.7% for the second quarter. And that increase reflected the continued economic impact of COVID-19, a resurgence in new cases caused by restrictions in the reopening of businesses in some parts of the country. Also, government assistance payments in the form of forgivable loans to businesses, grants to state and local governments, and social benefits to households all decreased during the period. U.S. unemployment rate ended the quarter at 4.8%. That was down significantly from 5.9% at the end of the second quarter. And again, it reflected continuing efforts to mitigate the economic impact of the pandemic. As far as the Fed is concerned, as you recall, in March of 2020, they decreased their target Fed funds rate from a range of 1.5% to 1.75% down to a target range of 0% to 0.25%. And they reiterated at their September 2021 meeting that they would maintain that target rate range until labor market conditions have reached levels consistent with their assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, they reaffirmed the continuation of the balance sheet normalization program that they launched in October of 2017. However, they did note that the economy has made progress towards their goals, and that if that progress continues, a reduction in the pace of asset purchases would soon be warranted. They also stated they would continue monitoring the implications of incoming information for the economic outlook, including public health information, inflation pressures, and inflation expectations, and international developments, and they would use their tools as appropriate to support the economy. They also acknowledged the slowing of the economic recovery, as well as indications of ongoing elevated inflation. And they reiterated that they would be prepared to adjust the stance of monetary policy as appropriate if risk emerged that could impede the attainment of their goals. As far as asset classes are concerned that we invest in, starting with real estate, the core U.S. commercial real estate market, as measured by the NCREIF Property Index, returned 5.23% for the quarter ended September 30th. That is the highest quarterly return on the NPI in the past 15 years. The trailing one-year return on NPI was 12.16%. Those increases in returns are attributable to improved performance across all property types, but particularly the continued astounding performance of industrial warehouse properties. Industrial returns were 10.92% in the third quarter. That's a one-quarter return. That's the highest return for industrial properties in the history of that index, and it's the highest of all property types since the inception of the index, edging out the apartment sector as delivering the greatest price increase over the history of the index. The gross total returns for each of the individual sectors during the quarter were retail 1.55%, hotel 1.83%, office 1.87%, apartment had a great quarter of 6.53%, and of course industrial 10.29%. Those are astounding numbers. As far as the energy markets are concerned, the WTI spot crude oil prices averaged about $70.58 a barrel during the quarter. And they ended the quarter at $75.22 a barrel, which was a 2% increase from the second quarter ending price of $73.52 a barrel. That continued ramp up in pricing was driven by strong demand recovery, OPEC plus supply uncertainty, and continued underinvestment in the sector. Third quarter demand recovered to about 98 million barrels per day. That's 98% of the pre-COVID demand of 100 million barrels per day back in 2019. Seems like a long time ago. Demand is expected to fully recover to 100 million barrels per day and possibly surpass all-time highs in the second half of this year. Most analysts remain pretty bullish on oil prices near term. Continuing demand recovery will ultimately dictate the trajectory of those long-term prices. In the gas markets, Henry Hub natural gas spot prices averaged $4.35 per million BTUs during the quarter, and they ended the quarter at $5.58 a million BTUs. That is a 47% increase from second quarter ending price of $3.79. Gas markets continued to tighten due to supply constraints related to Appalachian infrastructure, continued operator capital discipline, and moderated associated gas. On the demand side, increased power demand from years of coal to gas switching, increased LNG exports, and exports to Mexico have all also contributed to put upward pressure on oil prices. Turning to the numbers, if you'll look on page 2 of the report, and let me just preface this by saying this is an excellent quarter. It's one of the best quarters we've had in the history of the fund. Total NAV of the portfolio at September 30 was $5.56 billion. The portfolio itself, investments were about $5 billion of that. Looking at the gross returns without cash for the quarter, we were up 7.2%. versus 3.56% on the benchmark. That's an outperformance of 364 basis points for the quarter. The real estate sector of the portfolio was up 6.64%. Infrastructure was up 4.20%, and energy was up 10.51%. If you look across at the one-year returns, you'll see that the portfolio returned 24.5% for its trailing one-year return. That's the second highest of all time. We had one year trailing period back in March of 2012 that was slightly over 26%. But other than that, this is the highest trailing one-year return at quarterly measurement date in the history. So second highest. 24.5%. The benchmark was 11.35%. So we outperformed the benchmark by over 1,300 basis points. Now, what was driving those returns? One-year sector returns on each sector of the portfolio. Infrastructure was up 11.77%. Real estate, 17.12%, which are astoundingly good returns. But the energy sector for the one-year period ended September was up 47.36%. So it's just a testament to the foresight that the board had in years past, particularly in the 2013 to 2014 area, where we were making commitments to the energy sector when everybody else was running away from that sector. So it has really paid off for us. The 5-year return on the portfolio is 10.69% versus 6.67 on the benchmark, outperforming 402 basis points. So that's the average annual return for the past 5 years. Average annual return for the past 10 years is 12.8% on the benchmark versus 12.8 on the portfolio versus 803 on the benchmark, outperformance by 477 basis points. Of course, your policy return is based on the 5-year net of fees return. So looking at that, the portfolio net average annual return over the past 5 years has been 8.46%. The benchmark was 4.26%. So outperformance of 420 basis points. At September 30th, about 29% of our total existing capital commitments remained unfunded. 25% of real estate, 37% of infrastructure, and 24% of energy. Turning to page 3, you'll notice that the board approved no new investments during the third quarter. However, subsequent to the quarter on page 15, you'll see that you approved one new co-investment. That was for Capital Co-Investment 17 LLC. And that is a co-investment vehicle created to invest alongside Lime Rock Resources 5 and a group of other energy investors in a package of U.S. upstream oil and gas assets. Looking at the allocations by asset type, this is on page 7 and 8 of the report. On a purely invested basis, NAV basis, the allocation to real estate at the end of September 21 was 28% versus a target of 33%. Infrastructure was at 35% versus a target of 36%. And energy was at 37% versus a target of 31%. The main reason the energy is so much higher than the target, of course, is because of the dramatic appreciation in the value of that sector of the portfolio. Those allocation targets reflect the targets that were adopted by the board in April of 2021. And as you'll recall, they were designed to reduce exposure in the portfolio to the extreme levels of volatility in the energy sector going forward. Over time, however, those allocations will become more aligned with the policy allocation targets as the board makes new capital commitments in the various sectors and as more of the existing unfunded capital commitments become funded. On page 8, you'll see the allocations on the basis of invested plus unfunded commitments. And on that basis, real estate was at 30% versus a 33% target. Infrastructure was at 31% versus 36, and energy was at 40% versus 31%. As far as geographic diversification is concerned, on page 11 and 12, currently the allocation to the U.S. is about 96% of the portfolio compared to a target of 90%, and the international allocation is around 4% compared to a target of 10%. Of course, these allocation targets reflect new targets adopted by the board also in April of 21. Finally, looking at investment manager exposure on pages 13 and 14 of the report, on a purely invested basis, the portfolio is well diversified across a platform of 25 different investment managers. The policy statement limits exposure to any one manager to no more than 20% of the total portfolio. The exposure at September 30th to each manager are well within that range. The top 5 highest exposures are InCap Energy at 12.27%, USAA Equity Advisors at 8.74%, Macquarie Infrastructure Partners at 8.20%, InCap Flat Rock Midstream at 7.36%, and Clarion at 6.2%. The co-investment vehicles are grouped by manager and presented separately. The highest grouped co-investment exposures at the end of the quarter were InCap Flat Rock Midstream at 7.44%. They were followed by First Reserve at 5.8%, Intervest at 3.19%, and finally BlackRock at 3.05%. That concludes my presentation. As I said, this is a non-voting item, but I'm happy to answer any questions you may have.
Rusty, this is Michael. I just want to commend you and your team's work and performance, along with the investment committee. The proof is in the returns. Y'all are doing a great job.
Thank you so much. We appreciate that.
Yeah, Rusty, those numbers are great. Is there anything out there that we need to be aware of or looking forward to future commitments or any other items that you have any concerns, or does everything look pretty good right now?
Well, of course, a lot of that depends on what the Fed does, but there's every indication that they're going to start raising rates, and they may raise rates frequently. I've heard as few as 2 increases to as many as 7 increases over the next year. So it's anybody's guess, but I think it's all but certain that they're going to raise rates. My guess is somewhere between 3 and 4 times, probably a quarter point each, but they could start with 50. Inflation, as you know, is pretty high, and I think it's going to stick around with us for a while. I don't think it's permanent, but I think it's going to be around for a while. So ordinarily, that would be not good for most investments. But although the investments that we are investing in are sort of classical investment hedges, so there are generally mechanisms that adjust pricing of the assets so that they take account of inflation. So I would say that it's something that could have some short-term impact on valuations, but I think in the long term, it's not going to really impact this portfolio too much. Of course, when asset prices have increased as much as they have, it can make finding new investments a bit more difficult. But that's why we pay the managers the money that we pay them, and that's we pay them that because they're good at what they do, and their interests are aligned with ours. I think that most people that are investing in things that we invest in still have quite a bit of faith in multifamily assets and industrial warehouse assets in the real estate space. As far as energy is concerned, we still invest across the entire spectrum, oil and gas assets, renewable assets, what's called energy transition assets. So we're still finding a lot of opportunities now. In fact, we're seeing some pretty good opportunities roll out in the energy sector that are providing we expect will provide some co-investment opportunities for us. But where we really expect to be active this year is in the infrastructure sector. We have quite a few of our established successful infrastructure managers that are going to be in the market this year. We already know in advance that there are 4 that we do business with that are going to be raising funds this year. And if we don't allocate to them, we won't see them again for 3 years. So we expect to be pretty heavy in the infrastructure sector. And that would apply across oil and gas in the midstream sector, as well as essential services type investments. Does that answer your question?
Scott, you're on mute.
That was great. Thank you, Rusty.
You bet. Thank you, Scott. Good to see you.
You can't have a Zoom call without someone saying you're on mute.
This is true.
Well, that being a non-voting item, there being no further business before the school land board, the meeting is officially adjourned.